All right, so I think this is a little bit of a more pertinent question to ask because of the recent election results. What should we expect going forward in the markets? So this is a video on a very short and quite honestly oversimplified video on how the markets tend to do. Um, Under a Democratic presidency, how do they do under a Republican presidency? Once again, I will admit I am no expert on such things. This is stuff that people probably do their master's and doctoral theses on. Um, so this is a very broad, very broad view, and I claim to be no expert on such things. So that's why up here I'll have my sources that I've been looking at, and I'm also using my a note sheet here so I can keep on track, not take up any of your time. If you're watching this, thank you. I know your time is precious, and let's jump right in. So right here, how's the economy been looking under a Republican presidency and under a Democratic presidency? So the first source I went to, the Joint Economic Committee, and it's very simple. The Republican Party claims to be the party of maximum economic freedom and the prosperity that freedom makes possible. However, an analysis of economic performance since World War II under Democratic versus Republican presidents strongly suggests that claims that Republicans are better at managing the economy aren't true. And even right at the gate early on, they admit we don't fully get why, which some of this is going to be a mystery no matter what. But what we do know, and apparently what we do see right at the gate, is that the economy has grown faster under Democratic presidents. Under Democratic presidents, average economic growth has been 3.9%, average annualized growth rate of real GDP. And real GDP has grown about 1.6 times faster under Democrats on average, and average of Republican presidents has been 2.5%. So right out the gate, it's correlated. It doesn't cause it. Correlation does not equal causation. But right now, you still see the numbers, and this isn't meant to be prescriptive. This does not mean that we're going to see Biden overseeing economic expansion just because history has been kind to Democratic presidents, Truman, Kennedy, and Johnson, Carter, Clinton, and Obama to date. But to show that history in the past has shown that Democratic presidents seem to preside over a growth of real GDP in excess of the growth that Republican presidents see during their tenure. Moving on to the St. Louis Fed, one of the more important metrics, I think, GDP per capita, how much each person adds to the total GDP number, the measure of productivity. And the St. Louis Fed, I'll keep all of these links in the description box so that you can have them for yourself in your own personal intellectual enjoyment. Real GDP per capita has been increasing steadily since 2003. Obviously, the dip in 2008 and 2009 for the recession. Going back to my note sheet here, GDP per capita under Obama grew to $51,523 in 2016 from $46,930 in 2009. That's a 9.7% increase. GDP per capita under Trump grew from $57,429 in 2018 to $58,490 in 2019, a 1.8% increase. Now, I mean, right out the gate, there's not a whole lot of time to be given. You only get given a year. From 2018 to 2019, you had a 1.8% increase. I mean, Obama got, from 2009 to 2016, he had 7 years to watch this number go up. So right at the gate, Trump didn't have enough time, and that really does have to kind of be taken into effect here. Now, one of my favorite sources here, it's more informative, I think. Going to McLean, the years 1926 through 2019 are under analysis here. And between those years, you had a Republican president for 46 years, a Democratic president for 48 years, and the difference in returns is rather significant and warrants some more discussion. The average annual return for the S&P when we had a Republican president was 9.12%. Democratic president, the S&P averaged 14.94%, a premium of 5.8% a year on average. That is significant. And I actually didn't know that going into making this video, so I've learned a good bit doing this. reading for this. Now, obviously, they mentioned it's not deterministic. The past does not mean that the future is going to be so good. You break down the returns by specific presidential tenures. Calvin Coolidge actually comes out with the best returns, and he was a Republican. And though we only have stock returns starting in January 1926, we see that during the period, the annual return of the S&P 500 was 30.57%. And the next closest for returns was Ford, a Republican, 1974. August 1974 to December 1976 at 18.44%. And then right after that was Clinton for the best returns at 17.20% per year. And the Republicans also had Herbert Hoover, who presided over the Great Depression and tanked it with an annual average return of negative 27.19%. The president has, once again, significantly less control over the markets than most people think. I mean, there's no economy button on the Oval Office's desk right now that you just keep pressing and pressing and pressing and hoping that it works, that the economy continues to go up. The president has only so much power to do that. Now, the next thing that you got to kind of take into account, and McLean does a very good job of this, is if it's just the president controlling the White House and what party controls the White House, it's one thing. But what if the party controlling the White House also controls Congress? The results are substantial. So for the same years, 1926 to 2019, the S&P returned 9.66% if the party controlling the White House is not the same party controlling Congress. And they returned 14.52% if they're unified, a 5% premium a year. And there's a breakdown even more on the McLean website. I'll leave all the links up here for your personal intellectual endeavors. Under a unified Democrat, you had 14.52%. A unified Republican, 14.52%. Unified Democrat being the case for 34 years, a unified Republican being for 13 years. So the market clearly likes stability. Okay. The market likes the consistency that political leadership can bring, and we know that cash flows are more valuable when they're more consistent. So when companies in the S&P 500 see this kind of thing, it definitely bodes them well. They can make better decisions, knowing good and well the political landscape won't be a macroeconomic risk factor. And then you get to the divided case, which is very fascinating. If it's divided with a Republican president, and the other party owns at least one house of Congress, meaning the House or the Senate. That's been the case for 33 years, and it only returned 6.99%. Divided with the Democratic president for 14 years, meaning Democratic president and GOP-controlled House or Senate, it returned a massive 15.94% annual average. Once again, meaning some years are better, some years are worse than this, but it averaged out to 15.94%. That is a substantial difference in terms of compounding the worth of your investments over time. And here, for clarity and letting McLean speak for themselves, divided government means that at least one house of Congress or the presidency is controlled by the other party. Data from 1926 through 2019, unified government means that the presidency, the House, and the Senate are all controlled by a single party. Divided government means that at least one house of Congress or the presidency is controlled by the other party. If you take the return out one more decimal place, the Democrats still have a tiny edge over the Republicans here. Once again, this is all kind of whittling away at the assertion that Republicans are better for the markets. That's not necessarily true. The data doesn't show that out. But this is also a very strict interpretation of the data as well. Now, the interesting story is what happens in divided governments. Once again, you just saw up here, divided with a Republican, 6.99%, divided with a Democrat, 15.94%. And the premium averaging nearly 9% a year, by far the biggest premium that can be found with the data that's been given. And this isn't surprising. It isn't surprising to find that unified Democrats and unified Republicans running the political landscape have similar returns, but the division, divided and Democratic leadership, Democratic presidency, having a substantial return like that definitely took me for a bit of a trip. But once again, this isn't controlling for many variables: recessions, depressions, inflation, taxes, wars, all of which affect markets in their own unique ways. I'm only giving an eagle eye view, a very broad, oversimplified view. Once again, I am not an expert in such things, and I will leave it to the better minds than I. Turning to the next source, the evidence investor that I use, ignoring that, although it is hilarious. And we recognize here that the market is dominated by a few events. Should I blame George W. Bush, for the global financial crisis, which had really taken hold by the time that Obama took charge? Should I blame Hoover for the Great Depression? You have to understand that the numbers only tell you but so much. You have to control for a lot of incredible variables, which, the Great Depression happened once and knocked us out for about a decade. The Great Financial Crisis knocked us out 2008, 2009. So you have to keep it in perspective. And what about wars? How do wars affect the economy? Well, in that case, we have FDR and Truman in World War II, Truman, Eisenhower, Kennedy, Johnson, and Nixon overseeing Vietnam, Bush in 9/11 in the Iraq War, and the list goes on. So you have to keep in very firm perspective that these numbers still require very, very thorough interpretation. And that's going to inform your investment perspective if you're going off of a historical basis. Moving on, I do use the balance a lot. I will admit that openly. And I sat with them for a good chunk of this video. You can see them here twice rather than once, like everything else. And my question was, what GDP growth did we see under the presidents that we recently had? Reagan, I started with Reagan, saw 3.5% GDP growth. Clinton saw 3.9%. Obama saw 1.6%. Trump saw 0.4%. And most people are thinking the economy was great under Trump. The stock market was. The economy was okay. And the data bears that out. And then I break into the nitty gritty a little bit. With Reagan, you saw the Fed funds rate climb to 20% under a Paul Volcker-led Federal Reserve to combat inflation, which was running away. Budget grew 2.5% annually, and he cut income and corporate taxes, but raised payroll taxes and eased bank regulations, which played a part in the savings and loan crisis in the 80s. With Clinton, you saw NAFTA, the budget surplus of $70 billion, welfare reform in 1996, and he raised taxes on the wealthy with the Omnibus Act in 1993. Now, with Obama, you saw ARRA, cutting taxes, and also bailing out the auto industry in the Great Financial Crisis, Dodd-Frank, the Trans-Pacific Partnership, and Obamacare, or the Affordable Care Act. With Trump, you see cutting taxes and raised spending. He renegotiated NAFTA, left the TPP, the $2 trillion CARES Act, and the GDP is so far at a negative 1.1% per quarter average. But once again, COVID tanked the economy. So you can see how heavily things get skewed when you have a massive event like that, and things have to be controlled for accordingly. And I also have to mention here, a lot of these past information was during a time when the Fed funds rate was much, much higher. So Reagan oversaw the rise in the Fed funds rate up to 20%, and it's near zero right now, with the current chairman of the Federal Reserve, Mr. Jerome Powell, committing to keeping rates near zero or at zero for the next couple of years. He has not committed to negative rates. But that still remains to be seen because we didn't think we would get to zero in the first place. And I think that changes the economic landscape because money back then was expensive to borrow, and now it's so much cheaper, almost free. And that has to inform your economic perspective. If money's free, then how will businesses behave? If money is expensive, i.e., if taking out debt is expensive, how will businesses behave accordingly? And so far, we've seen that some businesses have gone crazy with debt, and some haven't in our current presidential administration. Now, moving on to inflation under presidents, we see on average, and I'm run to this source actually. So what I did, since the information wasn't aggregated the way I thought it would be, I just took a mathematical average for the years that I was looking for the presidents. That I was keeping my eye under. So with Bush, and I just took a mathematical average, saw a 2.41% average inflation. Obama, a 1.5% average inflation. With Trump, you saw inflation rise a little bit to 2.1% average. And once again, you want to aim for about 2%. In this case, the Fed says they want to aim for 2% over time rather than a hard on the nose 2% almost every year. And in this case, it's been rather controlled, honestly. It seems for these three presidents, it's been fluctuating around 1.5 to 2.41%. It's maintained a small bound in terms of, I guess, what you would expect good inflation to be around 2%. So this falls into that it falls into that segment. It has been around 2%. Sectors that tend to do well in recessions: communication services, financials, consumer discretionary, healthcare, consumer staples, industrials, energy, IT, logistics, DIY/repair, food and beverage. If it's an industry that relies on being low price or services or allows you to be cheaper with your spending, then it could do well in a recession. It doesn't mean it will, but there might be a better chance than most. I mean, everyone was running to the dollar menu in 2008. When you only had $1 to spend and you wanted something fat and greasy and disheartening, no pun intended on cholesterol, you went to McDonald's or Wendy's or Burger King. And Ross and TJ Maxx as well. Big Lots, I've done videos on Big Lots as well. Where they're cheaper retail shopping choices where your dollar can go farther in a harder economic landscape and you can get, i.e., more bang for your buck or whatever have you. You can go and you have your retail choices that tend to do much better. Ross and TJ Maxx also being publicly traded. They more than likely saw, I don't know, I don't have the data off on me, but I would definitely have a wild hunch that they did much better in 2008 and 2009 because people still had to have clothes, but they wanted to make sure that they were getting value for their money. So in sectors like these, they tend to do very well. And then also you have financials, which that was weird for me to kind of look at because I'm thinking, 2008 and 2009, I would imagine financials did not do well in that recession for reasons. But typically they apparently do well in recessions because when you see banks, you think, where are they going? I mean, you probably look at a bank and go, that's not going anywhere. Bank of America, JP Morgan, SunTrust, and that probably informs more investment decisions than anything else. Just the off the hand idea of, is this going to go bankrupt in the next 10 years? Probably not. Most of these big companies in these fields get away with that. So logistics, UPS, Old Dominion, food and beverage, Coke, Pepsi, Keurig, Dr. Pepper. You can look at those businesses and probably go, are they going to go anywhere? Probably not. And I imagine that they do well in a recession because people are looking at those businesses going, they're probably not going to go anywhere. They're seen as safe, perceived to be safe, which is why more than likely in economic hardship, recessions, depressions, bear markets, those sectors tend to do very well because they tend to have really big names going for them. And speaking of recessions, what does market performance look like under presidents? I went to Forbes. They tend to do very, very good financial exposés. Actually leaned on them for my Liberty Braves video. And they valued the Braves, attempted to value the Braves. They're privately held, so they did the best that they could. But they definitely do incredible work for retail investors like me that are trying to learn about the markets in a well-informed fashion. So this was my source. I once again stuck with. I started with H.W. Bush this time. And their source that they use is the Federal Reserve Bank of St. Louis in case you wanted to check the checkers. In this case, you wanted to check Forbes. H.W. Bush presiding over one expansion and one recession and debt to GDP at 61%. Under Clinton, debt to GDP dropped. And Democratic presidents saw 0 expansions but 0 recessions, which I imagine if you're not going down, then you're winning. In this case, you'd rather not have a recession. If you don't have an expansion, just hope you don't have a recession. So take Clinton not having one or the other for maybe a good sign. W. Bush, he saw 1 expansion, 2 recessions, and a rise from 55% debt to GDP to 68% debt to GDP. Obama oversaw 1 expansion, 0 recessions, and went from 68% debt to GDP, 104% debt to GDP. We saw a massive increase under him. And then Trump, the current president and current administration, 0 economic expansions. He actually inherited the bull market from Obama, which is why you don't see it here. And then 1 recession, COVID, and an expansion from 104% debt to GDP to 131% debt to GDP. So the tally ends up becoming 12 economic expansions, 12 recessions, and the corresponding presidencies showing 5 Democratic presidents seeing economic expansion, 7 Republican under economic expansions, 2 recessions for Democrats, and then 10 recessions for Republicans, and it evens out. That's I gotta chew on that one more. It evens out. The boom bust cycle still exists. And market valuations by president. I gotta tell you, I wanted to bite off a little more than I could chew with this video, and I wanted to see what sector, what industries performed best under what presidencies. But I gotta tell you, I don't think I'm that smart, and I don't think I have that kind of time. Because I feel like someone's doing a doctoral work on that right now. So I'll leave it up to that poor person to do it. Market valuation by president using the Shiller PE ratio. I don't like the Shiller PE ratio. It has its flaws. It doesn't account for accounting changes, for example, but let's run with it. We can have a conversation about this. Reagan, for those years, 81 through 89, you saw market expansion going from 9.26% times earnings to 15.09% times earnings. So this, for those of you that don't know what a Shiller PE ratio is, this is how you measure the value of the market currently. What is the market trading at? This tries to capture the value of the index that it's tracking, or the how expensive generally the market is right now. This is pretty cheap. This is getting to fair value. You want it to be under fair value. You want it to be undervalued. You want it to be cheap. So for those of you that are not necessarily in the investing landscape, you want it to at least be below 15. So you went from cheap to fair value under Reagan. H.W. Bush, you went from fair value to expensive, or becoming expensive. If you want to put it within a range of 15 to 20 is about expensive. Shiller PE would say here that under H.W. Bush, when he was leaving office in 1993, it was becoming expensive. Clinton went from expensive to even more expensive. And when he left office to give it to W. Bush, it went to 36.98 times earnings, and went from 36.98 times earnings when Bush went into office to when he left office. It went cheaper to 15.17%, 15.17 times earnings. Excuse me. Under Obama, it went even more expensive, from 15.17 to 28.06. Trump, even more expensive, 28.06 to 32.83%. 4 GOP presidents, 2 DNC presidents, 3 of those 4 GOP presidents seeing market valuations rise under their tenure, Bush being the outlier, as you can see here. And all the DNC presidents, Clinton and Obama, seeing the market valuations rise under their tenure. Once again, this is not a perfect way to do it, but this is the easiest way to give the eagle eye view of how the markets were valued around these kinds of times. So what do I try to make of this big bird's eye view? Well, if I want to be very strict about it, then the markets do better under Democratic leadership, but don't shoot them in the foot like that, because the president can't control the economy. They can be very, very one-sided towards being bullish and try to expand the economy. They can be one-sided towards being very concerned about the budget and so on and so forth. There's only so much that's under their purview before the market is going to do what the market is going to do. The information provided here doesn't account for extraordinary events that would change so much in terms of thinking about investing in the markets. Again, you don't plan for the Great Depression. You don't plan for COVID. You don't plan for the markets to respond that way, but that they do means that these percentages have to be adjusted accordingly. I once again stress that I am not giving a detailed view into this. I will leave that to the better minds. And going into a Biden presidency, what should we expect? It means we should expect retail investors to try to beat potential political headwinds by moving money into different asset classes and investing differently under the fears of Democrats not being market friendly. However, as I just tried to explore here, the data that we have proves the assertion to be of dubious nature at best. Democrats seem to be rather friendly towards the markets, and the markets seem to do well under Democratic presidencies, last I checked. Something as short term as a presidential term shouldn't be the be all end all of investing in the markets through the course of your life. If you're aiming to invest for 20 years or more, then this is nothing but a blip. This really isn't. Biden being a president for 4 potential years means that this is going to be nothing in the grand scheme of things. So don't let a Democratic president scare you into not investing in the markets. Don't let them do that. Don't be so flaky with your returns that you want to give that up just because it's a potential Democratic president. Before I close the video out, I'd like to point out I'm not giving you investing advice. This comes with risk. This is purely for general information purposes and isn't meant to constitute financial advice in any way or to do your own due diligence. All investing comes with risk. I actually really enjoyed coming up, finding the data for this and coming up to do this video. I'm interested to see where the next presidency takes the markets. And I will sit alongside you guys in the adventure and or headache that ensues. Thank you for watching. If you like the content, please subscribe, like, comment, critique. By all means, help me to get better at this so I can give you better content. Let me know what you think. And I hope to see you again in the next video. Thank you.